This Twin Peaks Investing podcast is brought to you in association with SharePad from ShareScope, the UK's #1 investment data and analysis software for private investors and traders. Visit sharescope.co.uk and discover the advantage.
Hello and welcome to this special Twin Peaks Investing podcast. As you can see, there's 3 of us on the pod today, and it is the 30th of October. It is UK Budget Day with Rachel Reeves. So we've got a financial expert with us today to talk about all things Polar Capital Global Financial Trust and a little bit about the budget. It's going to help us out a little bit on there. We have Tom Dorner, co-fund manager at PCFT and part of the financials team at Polar Capital. Welcome, Tom.
Welcome. Thanks for having me.
I just need you to just pull your volume up for a little bit for me there, Tom.
So
right, I can hear you a bit better.
Okay, yeah. So better now?
Okay, that's much better. Thank you.
Okay.
And also, of course, we've got my co-host with me, Henry Viola here. You can find him at HT Viola. So, Tom, we are here on the 30th of October. Markets have been expecting all kinds of shenanigans from Rachel Reeves. The markets have been in a doom loop for weeks. AIM stock's been selling off for several weeks. Lots of the larger and most selected AIM IHT stocks have been absolutely smashed. And then today, the news came, markets wobbled, and then the AIM stocks went on an absolute tear. I'm just going to break some numbers down before we ask you the main question. The FTSE finished down 0.73%. FTSE 100 was at 8,159. It's the lowest close for some time. And FTSE 250 down 0.35% at 20,694. FTSE All Share, finished 0.56% down 4,464. And then the AIM rally happened. FTSE AIM UK 50 index up a full 5%. I'm not sure how many years since it moved that amount, but today it did at 4,106. FTSE AIM 100, the top 100 stocks on the FTSE AIM, closed up 4.3%. And the FTSE AIM All Share closed up 4.03% at 744. So a relief rally for AIM shares. What did you make? What was your first impressions of this budget, Tom, when you heard it today?
Yeah, okay. So, as you already said, Peter, there was quite a lot of speculation. I can't recall the budget that was anticipated to the extent that this one was. I think in the context of the hype surrounding it, it felt like actually, certainly the delivery and the messaging was pretty orderly. I mean, the heavy lifting in terms of this 22 billion black hole that we've heard about many times is being done by the increase in national insurance paid by employers. So I think that had been expected by lots of people ahead of time. So you've got kind of a significant increase in tax, but in the way that was expected. Lots more spending, a bit more debt that maybe the market was a bit concerned about at times. I think some of the points you mentioned around inheritance tax, perhaps that was, and some of the potential reform around pensions was perhaps less onerous than people had thought. So that would have helped. I mean, if I look at some of the financials, some of the bigger banks were up a bit, the bigger insurance companies were up in the sort of relief rally that you referred to. So I think it was pretty well received. Now, obviously, the really big question is, does this budget over time translate into the sort of growth that we've been promised by Rachel Reeves and others? Because that really would be a sort of a game changer for the UK. And she set out very clearly her frustrations with the state in which the previous government left finances. So I think it actually landed relatively well. And markets seem to like it. I mean, it was less bad than people had feared. So that's our initial take.
Yeah, I think that's a general take as well. Less bad. I think the smaller companies of AIM actually was like, because I was reading Peel Hunt's report saying potentially if she'd just gone, that's it, done, IHT's out, then we would have seen 20-30% falls on some stocks that had already fallen by 15-20% already. So that was some significant moves today. Henry, you were looking at it as well regarding small stocks, and we're all having conversations on various platforms about everyone selling out of AIM. The market's just going like that. Really good quality stocks are being sold off. And then today, as you said earlier, you know, in private conversations, markets on AIM anyway were rallying. The FTSE, not so much, 0.5% down, still worried about levels of borrowing, I suspect. What were your thoughts?
Yeah, I mean, I think Labour were particularly keen to avoid a Liz Truss moment with this one, and I think an awful lot of this had been leaked in advance. You know, I was reading a headline earlier that the Speaker has actually sort of reprimanded Rachel Reeves and her team for leaking so much of the budget in advance, and saying that really this ought to be announced in Parliament first before you go briefing papers. Having said that, I also feel that that calmed the markets a lot. You know, I was talking to someone this morning and saying I woke up feeling like I don't know if I'm still going to have a portfolio at the end of the day. I hope I do. I hope this isn't doomsday, but you're never quite sure. And actually coming out of the back end of it, I'm quite relieved, to be honest. There's no major shocks in there. A lot of this was signposted, and like Tom said, it felt very orderly and well communicated. You know, I was particularly impressed by the way Rachel Reeves actually stood up in Parliament and delivered the budget. I thought she did very well and was a very credible voice.
She did well. I think she's been preparing for this one as the first lady in, I don't know, somebody said 800 years before. I'm not sure if that's accurate or not. But yeah, and it was a case of it wouldn't matter what she did, there would be critique of it anyway. So she was preparing for the worst and delivered much better than people expected. One of the pleasing announcements we've got to talk about, Tom, because we're going to talk about your trust in a moment, was obviously the element of the budget regarding ISA allowances as well, and they were frozen and will be continued to be at subscription levels, remain at 20,000 for ISAs till 2030 at present, and which is good. So we've got that sort of level of uncertainty is now gone, and ISA allowance will be 4,000. And junior ISAs will be 9,000 until 5th of April 2030. So that helps, knowing full well that, you know, talking about your trust later on, there'll be more people willing to invest longer term, knowing that uncertainty is no longer there.
Yeah, absolutely. I mean, we have anything that can be done to encourage people to consider investing in the stock market in the UK through various different vehicles available, I think is a good thing, you know. I mean, we've been using our ISA allowance in our family every year. I think it's a great vehicle. So I think that was a helpful announcement. Absolutely.
I think that longevity was something that I noticed quite a lot. She does seem to have made, Rachel and her team seem to have made an awful lot of announcements that are dated many years in advance. She's not sort of stood up and gone, we're doing this for 6 months and then we'll review. We're doing this for 12 months and then we'll review. She's announced long-standing spending programs and allowances and fixed things. And that was something I was very, very grateful for, because I feel like we've just been playing political ping pong with the budget for what feels like forever. But actually, if you go back a decade or two, things weren't like this at all. So it was nice to see some of that longevity returning to those announcements.
Agreed, Henry. I mean, I'm just going to whistle stop a few stocks here that were embraced by the relief regarding AIM IHT. Craneware was plus 20%. All these stocks, by the way, have been sold off of late. So Craneware plus 20%. Pop today. What we got here? Advanced Medical Solutions plus 14.6%. Brooks McDonald plus 13%. GBG Group plus 10.5%. We've got Judges Scientific was up 5.9%. James Halstead plus 6%. CVS Group, which has got its own issues regarding pet stuff, up 7%. Cohort up 5%. Gamma up 2.9%. Renew Holdings up 5.7%. Judged Scientific up 5%. So you've got quite a lot of stocks. Volex, a popular one with AIM holders, and was up 6%, and
You've
Cerillion
missed a
up
big one.
5.5%.
I've got a holding in a little environmentals manufacturing business, Alumask. That was up 13.5% today. I've not actually had a chance to check my portfolio till I left the pub at the end of the day. And not that I've been in the pub all day, I should say. I was having a drink after work, but got on the tube,
celebrating your portfolio still being a portfolio. We know, Henry, we know. we know. So you're seeing all of that rally on AIM, and you mentioned earlier, Tom, we're going to talk about your PCFT in a minute, that the financials held their ground-ish today. They didn't pop, but they didn't really sink. So we had the volatility on the gilts. It went down as she started the announcement. It went up shortly after, in the midst of it, and then it finished almost flat today. So it wasn't a case of it's gone back below 4, but it didn't spike and really significantly worsen, as was feared. Everyone was like Armageddon was happening. So that must be good for financials going forward.
Yeah, I mean, I think when you quoted some of the moves, the first thing I thought was, God, I wish we had exposure to some of those. But the reality is that the way that given the size of the trust and the process that we follow, we tend to be quite sort of longer term in the way that we think about things. I mean, we can be opportunistic, but unlikely to trade around, particularly macro events like this, for the very reason that we discussed at the beginning, that it really did feel like, there was quite a lot of risk, right? I mean, it turned out that it was a relatively benign delivery, and as a result, as you point out, some stocks did well. But I mean, I'm sure we'll talk about the US election. There are just so many major political and economic events happening that feel quite binary. So we really haven't done a tremendous amount in the portfolio. So we're happy that we own some UK banks and they recovered a bit today. So we're sort of happy with that, but not the order of magnitude that you've talked about. But I suppose, as you say, some of those had dropped heavily before as well.
Absolutely, yeah, spot on. Thank you for that, Henry. We're just going to close on the budget now. Is any final questions you want to ask? I'm conscious that we could be talking about the farmers and the impact on their relief, agricultural relief, and stuff like that. But we could be here all day. Is there any particular ones you want to talk about before we go?
Well, I mean, I guess the obvious question for me, and bear in mind that you've just said you don't trade around macro events, but do you feel more or less confident about the prospects for the UK after today's budget, or are you fairly agnostic on it as it's a one-day event? Let's see how things pan out. What's your take on that?
Yeah, it's a fair question, Henry. I mean, I think the answer is that, I think we felt that the Labour Party promised to be sort of quite sensible. The start of their tenure has been marred by riots and other things, so it perhaps hasn't been the sort of wonderful start. But there was a lot of focus on today, and it felt like it delivered a sense of sort of stability and credibility that I think has been missing for a long time. Because, of course, don't forget, in a context of global investors, our investment trust is a global trust. The UK is not that big in the benchmark, so I think it's easy for people, when they've seen some of the political shenanigans and previous budgets that went very wrong, to just say that this is a risk that we don't want to take. So to answer your question, I think it's reassuring. I don't have an answer as to whether really in the end it drives growth. I mean, I was talking to a friend of mine as I was traveling today. He runs an estate agency business, and he's, the increased national insurance contributions he's going to have to make are going to affect his decisions at the margin about hiring or so. But it's all really hot off the press. So I think it seems so far to be encouraging. Let's wait, see how the dust settles, see if there are any gremlins in the detail that we haven't thought about. But but initial impressions like relatively encouraging. I mean, we are actually, as it happens, overweight the UK relative to our benchmark in the portfolio, but tends to be businesses that can be quite international, so not necessarily that affected by this. But the domestic businesses that we own, like Barclays or NatWest, actually, you know, the fact that they avoided the worst outcome is encouraging for us.
Brilliant.
Thank
I'm
you
going to
very
ask you one
much. That's a
question
good
because of what
answer.
you've just said there, Tom, if I may. You mentioned that your friend that works at the estate agency or runs an estate agency. One of the things on the budget today was talking about stamp duty on second homes. Is he going to become busier, you know, regarding, you know, people selling up and going, oh my gosh, here we go. Stamp duty's gone up 5% from tomorrow.
Yeah.
Will that help banks and help estate agencies, do you think? I just thought it was timely. I'm not trying to get you on the hook here to make
Yeah,
it.
no,
You can
no,
pass. You can pass on the question.
you know what? I'm going to pass on it. I mean, like the national insurance contribution thing is a much more immediate thing for people to think about. What the second order consequences of the change in tax it's quite hard. So if I said something, I feel like I'd be sort of just shooting from the hip. I don't have a strong view on that, to be honest.
That's absolutely cool. Right, now we've warmed you up. We can fully introduce you, I think, Tom, if you're ready. Thank you ever so much for enduring that. Ladies and gents, we have got Tom Dorner, fund manager at the financials team at Polar Cap Financials Trust, co-managing that with Nick Brind and George Barrow. He's joining us today on the pod to talk all things PCFT. He's got a fantastic background, but the bit that jumps out of the page for Henry is the fact, Tom, that you are not only a qualified and chartered accountant with Ernst & Young, but you're also a Nottingham University graduate. So forget all the other things you've done, you know, Standard Life, Aberdeen, Citigroup, etc., etc. If I get all those right, you're from Nottingham. So I'm going to go over to Henry now to ask you something random, and then we'll get into the proper questions. Henry?
Well, I'm going to ask you the thing that everybody asks everybody from Nottingham. Have you ever been to Rock City, Tom?
No, I have not.
Oh,
that's a very random question.
Sorry to disappoint.
I'll ask you a kinder second one in that case. Did you enjoy your time at Nottingham University?
Yeah, I enjoyed it very much. I spent a lot of time there before I was doing a master's there too. I thought it's a really nice student town. It was a great place. I did a master's in philosophy for my sins. I mean, nothing to do with financial services at all. And there was a point at which I thought, wouldn't it be interesting to do a PhD in philosophy? And then I think I just reflected on things and thought, I'm not sure the academic life is for me. And then eventually things led to, you know, moving down to London and getting a job as trying to qualify as a chartered accountant. But I have very fond memories of my time in Nottingham.
Excellent. I'm glad to hear it. I mean, I'm up there regularly. I'm from Nottingham originally, so you know, best city in the world as far as I'm concerned.
Yeah. I'll take your word for
it. Right. So, Tom, journey-wise, Aberdeen Standard Investments, chartered accountant, Ernst & Young, Citi, and Lehman Brothers. Why and how did that journey lead to Polar Cap? Because you talked about philosophy, you talked about becoming a chartered accountant, and then the markets just went, this is a very, very smart chap. Let's have him. What happened?
That's very, very generous of you to say, Peter. I became a chartered accountant because I sort of didn't really know what else to do. My uncle was a chartered accountant. It felt like quite a good move to get paid to get a qualification. So I sort of enjoyed that, and then came to the end of that and thought, actually, I had an opportunity to work at Lehman Brothers with someone that I worked with previously, doing sort of equity research on insurance companies, and that was working at Lehman Brothers was an interesting experience, very very intense. I actually resigned and left Lehman Brothers just literally 3 weeks or so before it folded. So I was on gardening leave at home, reading the newspaper, seeing that, you know, some of my colleagues walk out the door with boxes in their hands. So it was quite interesting. I then worked at a sort of smaller broker, so I felt like I had experience of working at big banks and smaller banks. And the real sort of transformation that happened for me was I got the opportunity to join Standard Life Investments, as it was. That was back in 2014. And that was sort of making a transition from being a sell-side equity research analyst to being an actual investor. And that was the best thing that's happened to me career-wise. It's just such a fantastic place to work. It was just full of very smart people that were very collegiate, very smart and nice people. And it led us to move up to Edinburgh, which is where I'm speaking from at the moment. And we love living up here. So that sort of was the transition to the buy side. And I'd been at what then became Aberdeen for the best part of a decade, being a European portfolio manager, looking at European financials. And I came across the team at Polar. So I'd known some people at Polar, but I didn't know the global financials team. I got sort of put in touch with them, and I thought, wow, I really like Polar's really a great place, and it's everything that it promised that it would be, properly committed to active management of portfolios, really caring about investing and supporting the investors. So it was a great place, combined with the opportunity to work on this Polar Capital Global Financials Trust, which is a pretty unique vehicle, the only investment trust that's really focused on global financials, run by a team of dedicated specialists that have been doing this for a decade. So combination of Polar plus a fund that I was interested in and a subject matter financials that I've been doing for 20 plus years, it just felt like too good an opportunity to pass on. So I joined at the end of last year and really thoroughly enjoying it.
Thank you for that. So you're coming up, well, essentially in a couple of weeks' time, X amount of weeks' time, to your first anniversary as part of the team. I know they're going to listen to this pod, so you might want to answer this one carefully. Has it been a good first year, Tom?
Yeah, it has been. It's going from Europe to looking at financials globally it's an eye opener, really. I mean, I've spent some time in the US looking at US insurance companies. We spent time analyzing and actually investing in some Korean banks. So it's sort of just the whole gambit, really. And yeah, so the team is really competent, really nice, very welcoming. So yeah, it's been good. We're working on trying to market the fund with more sort of energy, let's say, and that's the initial signs are very good. The performance on the trust has been okay as well. So so far so good. I'm very happy.
Brilliant. Thank you very much. Right. Okay, I'm going to ask you a couple of questions going forward now. So we're in the financial space. We've got all kinds of stuff going on regarding the budget we've had today. Some uncertainty has been relieved. We've got the US elections coming next. As if we're not, it's like being in a boxing ring at the moment, it feels, as investors and fund managers. Why is now a good time to invest in financials, and especially when the market seems so focused on everything tech and AI, in your view, Tom?
Yeah. So I think that there's sort of two aspects to answering that. I mean, from my point of view, at least. The first is that financial services companies, generally speaking, are now delivering much better returns than they were before. So there is this sort of negative muscle memory that some people have towards of a time between the financial crisis and COVID, when you had extremely low interest rates and very tough regulation, and the companies constantly sort of struggling to deliver attractive returns. And actually, I think, if you take a step back, actually financials are the second biggest sector within global equities. So it's hugely relevant, but has been somewhat neglected because some of these sort of negative headwinds. And that's reasonable, but that's an outdated view now. As we stand today, interest rates are a bit higher. Return on equity for banks and insurance companies are really, really good. They've got strong balance sheets, paying huge dividends in many cases, or doing large share buybacks. And I think so that's one of the reasons I'd say now is a good time to think about it, because while everybody else is focused on things like, you say, tech or other things, here's a sector that's sort of under-owned, but actually where things have got a lot better. And that's the sort of second component to an answer. So things are better in terms of returns for financials, but the other question is, what's the risk reward on the alternatives? You want to think about, do you want to follow the herd? I mean, we all read countless times how concentrated global equities are. You almost certainly underappreciate how much exposure you have in a portfolio that owns global funds or US funds to a very small number of companies. So like this sort of extreme positioning in global equities makes financials on a relative basis attractive as well, because valuations are still really attractive. So global financials are on a PE of 12, global equities on a PE of 22. I mean, not far off twice the multiple. So the clients need to think about diversifying away. And our pitch is that financials are a really great way to do that. And actually, if you look at how the global financial sector, which we're benchmarked against, has performed, it's outperformed global equities this year, also over 1 year and over 3 years. So basically, our view would be returns are better than the past, valuations are still attractive, and it's a really good time to think about diversifying away from things that are very popular in the market.
This is a quick hello to you, our valued Twin Peaks Investing podcast listener. Whatever channel you're listening to, please make sure to subscribe and you'll always be the first to get the new episodes. Thank you for your continued support.
Thank you for that reply. And really, any thoughts regarding that response and your thoughts on markets? I know you've always been a little bit regarding financials on certain instances.
Yeah, I mean, you make a really good point about markets globally and indexes being concentrated in a few specific sectors. Everyone's going crazy for AI and the like, and therefore there should be opportunities in things like financials. You're fishing in that pond, so you find the best bets, right? But I've always viewed financials as potentially quite a risky bet. You're never quite sure what's going on under the bonnet. And I wondered if you could tell me a little bit about how do you balance things like credit risk with yield? So, if you've got a high yield financial, presumably the credit risk is also fairly high because it's in lower rated instruments. How do you balance this sort of risk versus reward in the financial space?
Yeah, that's a good question, Henry. I mean, I guess anything is risky if you don't really understand it. So the best way to try to mitigate risk and to manage the risk reward that you were asking about is to try and do sort of proper fundamental research. Now, I get it, financials sound scary, sound complicated. When I was running a European fund, consumer staples or luxury goods companies are much easier to understand. And banks or insurance companies can have very high investment leverage that makes the stocks quite volatile. But the good thing about the way that we do it is that between the five of us, we've got almost 100 years worth of combined experience looking at financials, which is I hope doesn't make us sound as just old and boring people, but it's the sorts of ways that you think about this is you do the normal sort of analysis that you might do about, let's think about the competitive position of the business, the management strength, capital, and generally speaking, actually, I would say that it's probably fair to say that the businesses generally, financials, are better managed with stronger balance sheets than they've been in the past. So look, there's no way getting around it. You need to be an expert in this sector, I think. We feel in a pretty good position to have the credentials to do that. But the answer to your question is you have to really understand the underlying business as well. Otherwise, you do expose yourself to risk.
Yeah, that's I was going to say there was a bit of a follow-up I'd got on that actually. So I was having a look at some of your holdings, and you've got a position in JP Morgan.
Yes.
And that name means a lot to me. I don't have a position in it, but I've always heard JP Morgan be touted as sort of this gold-plated risk manager. They're a very, very secure, very well-managed bank, have been for years. Jamie Dimon is sort of a very smart, capable manager. I wondered if you could talk a little bit about how you view JP Morgan, for example, and why you like that over, say, I don't know, Lloyds Bank or whoever.
Yeah, fair enough. I mean, I think you've partly answered it. I mean, the JP Morgan's been a big holding in the trust for a long time. And, maybe it would be interesting to just invest in really esoteric things that you've never heard of. Sometimes, the best ideas are hiding in plain sight, and that's our view about JP Morgan. So, biggest bank in the world. You've already mentioned the excellent management. I mean, Jamie Dimon is always a very fascinating person to listen to. Tends to talk things down, which is a smart thing to do. They've got, as a business, a really strong position in the US, but they're also really sort of innovative. I mean, in the UK, you've got Chase, mobile-only bank that's sort of being interesting and disruptive. They have this sort of concept of a fortress balance sheet as well, in terms of making sure that, and that's the sort of thing that if you've invested in financials for a while, the balance sheet is the most important thing to get right. Like, doesn't matter how good the earnings look, if the balance sheet's weak, that tends to be where you get into trouble. So, fortunately for JP Morgan, it's rock solid, and as a result of that, it's been a really attractive compounder. So, we like it for many of the reasons that you mentioned, and some of the ones that I just mentioned, and it's been in the trust for a long time, and we're sort of pretty happy with that, to be honest.
Brilliant. Thank you for that, Tom. Now I'm going to backtrack a little bit and ask you to just give us a bit more, for those that haven't, been introduced to Polar Capital Global Financial Trust before. Give us a little bit of intro and a background to it, and also tell us a little bit more beyond what you've just said about the balance sheets being important, etc. About how you and the team, Tom, go about selecting the stocks that you've decided to pick, because you have got quite a large area and space to actually pick from, and as you say, the quality of those financial stocks globally varies somewhat. And you've got countries which no one else embarks upon, where you've got some selections from as well.
Yeah, no, absolutely. So just in terms of the trust, so Polar Capital Global Financials Trust, or PCFT as it's affectionately known by us, it's got about 570 million of assets under management, so it's a good size. In our team, we have a couple of other vehicles. We just recently converted a fund into sort of a credit fund, but in terms of what matters to us, the trust is by far and away the most important thing. The only thing that I spend my time on. It's been around for a decade, so it's got scale and longevity. As I think we were discussing earlier on, I think it's a pretty differentiated product, because there's not many vehicles that focus on financials. It's the only trust that really looks at global financials, and within the context of Polar, it's a great place to be because I mean, my view at least is that in asset management at the moment, to succeed, you either want to be extremely big, or you want to be a place that really fosters sort of differentiated products, and Polar is does exactly that. So it's a great home for the trust, in my view, and the long-term returns, actually, since the trust was created a decade ago, the compound returns have been about 9% per annum, which I think is a pretty good, respectable return, if you bear in mind what we were talking about earlier, that there were periods after the financial crisis when things were pretty challenging for bits of the sector. So that's the trust. In terms of how we work, so I think we were saying there are 5 of us in the team. We're pretty unconstrained in terms of what we can do. So to your point about we can pretty much go anywhere and invest in anything in financials. So is it banks? Is it insurance companies? Is it stock exchanges? Payments is within our benchmark. So we've got some holdings in payments companies as well. In terms of the way that we sort of think about things, generally speaking, we prefer better quality companies, partly because of some of the risks in the sector that we sort of talked about. But there are specific ideas that we own that are more kind of what we think of as like turnaround or recovery ideas, where there's a sort of high risk, high reward. Like Barclays in the UK would be an example of that for us, where there's significant change happening. You've got management implementing a new strategy, more focus on the UK, more focus on fixing the IB, in a business that historically would have been viewed as quite underachieving. So we do have some of those ideas where we think that through our expertise we can identify favorable risk rewards. But but yeah, that's broadly how we sort of do it. It's pretty great in the sense that we're very flexible, but we want to try and on average err towards quality within our sector, I think.
Brilliant. Thank you for that. Now you mentioned Barclays. Henry's already mentioned JP Morgan, but you just mentioned there payments and also insurance companies. Can you give us some examples of those that you've picked and why you've picked those beyond others in that particular sector, please?
Yeah, absolutely. So yeah, I'll tell you, an insurance company that we've liked again for quite some time is called Arch Capital. So it's a sort of it's like one of these fantastic insurance companies you've probably never heard of. So it's based in Bermuda. It's a Bermuda-based insurer and reinsurer. It's set up about 20 years ago. And the thing that's really special about this business is the track record of the management team of moving in and out of cycles, because the insurance industry can be quite cyclical at times, and they're very good at knowing when to go big into something and when to sort of pull back. So in the sort of more cyclical end market, that capital allocation piece is really important. They've got a really good track record of doing that. They started out doing casualty insurance and catastrophe reinsurance, and bought a mortgage insurance business. They have stake in credit insurance, but each of them they always feel like the smartest guys in the room. So that's the reason why that's been a holding in the trust for a long time, and one where we just think that they're better at making those sort of capital allocation decisions relative to their peers. There are other insurance companies that we like too, but this is one that we've got a sort of particular soft spot for, and you might not have come across, in the UK. And actually, if you look at the share price over the long term, it's been a fantastic compound.
Brilliant, thank you. And the payments ones that you've
Yeah,
selected recently or held for a long time, please?
Yeah, absolutely. I mean, so in payments, we own MasterCard is our biggest holding, but one that we've bought more recently that might be more interesting to talk about, because I think sort of MasterCard is very well covered generally, and it's a very good business. But we bought FIS, which is an American company that does sort of software for the banking and financial services industry, sort of core operating software. So effectively like the IT-based plumbing. And they under previous management team had a sort of foray of trying to buy into payments. So they've exited that. They still have a stake in a business called WorldPay, which is why it sort of sits within the payments category. But that's one where there's a real sort of change or turnaround case. It's away from the exuberant attempt to get into payments, back to the traditional boring plumbing, but that's really reliable and safe bit of the business. So yeah, that's one that we've bought a position in earlier this year, and it's done quite well for us.
Okay, so it's saying here as one of the world's largest payments processors. So that, as you said, that's part of the infrastructure of the fintech ecosystem. So basically, all the others having to work alongside it, not compete with it, sort of thing. Is that what you're saying?
It's kind of like effectively like the software that they do will be like integral to the way that banks work. And once think of it as like the IT related plumbing within a bank. Like once you're in, like ripping that out is very unlikely. So what it does is it gives you a bit of pricing power. It's a bit like, if you use Bloomberg, So it's quite an interesting business. Our analyst who looks at the US, Nabil, knows it really well. It's got lots of hallmarks of sort of business that's gone through change, sort of new management, better targets, sorting out the strategy, back to the core of plumbing with a bit of pricing power is actually quite nice. Thank you very much.
Yeah, pricing power is very important. No, thank you for that. It's one I will definitely be having a look at. I know we know of WorldPay, but I didn't know that's where it resided now in FIS. So that's very interesting.
Yeah, so they bought it and have since sold a big stake, but they still have a stake in it. So yeah it's untangling that's actually allowing them to do capital returns to shareholders, which is not a bad thing as well.
And again, strengthens the balance sheet as well for different purchases if they want to go forward with more processing power. Henry, any thoughts regarding some of the stocks that Tom's already mentioned, or do you want to add a question in there somewhere?
Yeah, I mean, my question on the payment side, really, I mean, I've looked at a lot of payment processors over the years. I don't currently own any myself, but the challenge I've always found is how to know which ones are getting ahead. I mean, how do you go about selecting a couple of names in this sector? Do you just buy the biggest? Do you buy the ones with the fattest margins? What's your selection process like for it?
Yeah. No, it's a good question. I mean, the companies that we own, we have a holding in Visa and a bigger holding in Mastercard, and they sort of it's similar to the conversation we're having around FIS. I mean, they're just so integral to the payment sort of architecture that the strength of that competitive positioning. I mean, there are interesting payment acquirers. I mean, the trust has owned Adyen in the past, but the competitive position for some of the networks is just so strong. And there are, there are always regulatory risks because they are effectively a duopoly, and but they do also try to innovate through adding more sort of. In the past, the growth all came from the transition from cash to digital payments. Now there's more effort to do value-added services, more data and analytics where you can fraud prevention, where you can enhance the service provision to your clients. So I think from our point of view, those have been just such reliable sources of steady growth for us, and for that reason have been in the portfolio for quite a long time. That really trying to pick whatever the next new big payment acquirer is actually much harder. And some of them, I mean, Worldline has had a really tough time recently. So there was a period a few years ago, particularly and not unsurprisingly, because of when interest rates were very low, these businesses were just so hot, and everyone was trying to see what's the next one, and they all had spun out of banks in the past, and we're all acquiring lots of businesses. I mean, and in my previous place, we used to invest in Wirecard, which then had a really sort of tragic end to the story. So I think for choice, I mean, my colleague George is really the expert on these stocks, but I feel quite comfortable with the sort of boring but very, very strongly positioned gradual compounders rather than the next big hot thing.
Gotcha. That's a really good response. I mean, the one of the names over here that recently listed, and the name has, just as I've said, it's just slipped out of my mind. It only listed in the last year or two. Wise, that was it. Currency Transfer.
Yeah.
And I looked at it, and it seems to be growing at an absolutely phenomenal rate. And yet it's also priced for perfection out to year dot. And I just thought the risk of this slowing down or going wrong is just terrific. Whereas you look at something like Visa or MasterCard, like you say, and since 2008, they've just been on a slow, steady march up and up and up. So I can totally see the logic behind that.
Yeah, that's pretty much it.
Thank you for that, Tom. You mentioned the fact that you're looking for steady compounders in the portfolio, and given that sort of thesis for the trust, the main sectors and themes that you're positioned for the long term, because you're long-term investors, you're not buying something for the next quarter or the next 3 or 4 quarters. You're looking for the compounders over the next 3, 4, 5 and longer years. So themes wise, are we talking about the banks, insurance sectors mainly? Is there some AI in there as well to give it that extra boost, so you can get a little bit of the the Mega 7, trying to help you out a little bit?
Okay, let's go through a couple, and then maybe we can talk about AI, which maybe you won't be surprised to hear doesn't feature very heavily in what we're doing. But yeah, a couple of things that we think are really interesting long-term trends. So we like the alternative asset managers, so private markets players, either both private equity and private credit. So that's a really interesting dynamic. I mean, they've performed quite well, but they really have got some strong structural tailwinds. I mean, the demand for private equity or private market exposure from all asset allocators is, that's sort of well documented. In terms of private credit or private lending, in many cases, banks have sort of pulled back, or now actually in some cases are partnering with some of these private markets players. The business models are quite are better than normal asset management business models in the sense that if you're a customer of theirs, if you give them capital to invest, it's tied up. It's generally done quite well for you, and they've earned some nice performance fees. There's been a bit of a sort of an air pocket in terms of ability to sell and realize some of these investments recently. But over the longer term, those look like pretty well-positioned structural growers. So we like sort of alternative asset managers and the sorts of names that we own. In the UK, we own Intermediate Capital Group. In the US, we own Ares and a couple of others. So that's one theme I'd sort of call out. Another is along the lines of what we discussed with Arch. It's reinsurance and commercial insurance, but basically it's a bull market for reinsurance and has been for the last 12, 18 months. That's because the previous period returns were pretty poor. And now actually they've had a bit more favorable supply demand dynamic. Pricing power has got a lot stronger. So actually they're all growing quite nicely. And that's delivering high return on equity, good book value per share growth. I mean, there's always a bit of volatility around hurricanes and that kind of thing, but the balance sheets are really strong. So our view is that's a more sort of cyclical theme that we're playing, but we feel that the longevity of that cyclicality is greater than the market appreciates. And then maybe the last one on banks, where so banks represent under 40% of the portfolio. That's probably, in the past would have dominated conversations we've had with investors, but actually, the portfolio has a lot of exposure to lots of different subsectors. But we do own some banks. I mean, we like European banks, a number of banks in Europe where, frankly, they've been getting really big earnings upgrades because interest rates were higher. They've actually, as a cohort, European banks have outperformed the US banks for a couple of years now, but the valuations are still really attractive because they keep getting earnings upgrades. They're making, one holding that we really like and have done for a while is UniCredit in Italy. It's one of our sort of bigger positions, really sort of, again, strong CEO, set out a clear strategy, transformed a business with a patchy track record, now delivering strong ROEs, big capital return, and trying to buy Commerzbank in Germany, which is interesting. So we like European banks. We're selected globally. We also have a couple of like Korean bank holdings where we think the valuations are just really distressed, but we're sort of somewhat selective in banks, I would say. So those are a couple of different bits and pieces that we find interesting at the moment. So hopefully that's interesting to you.
Brilliant. No, thank you for that reply. I'm interested in what you've just said there, and all of it. I could ask you several questions, but possibly the most topical one is this push and pull between Commerzbank and UniCredit. And we're not talking about the banks per se. We're talking about geopolitics coming in the middle of that as to whether that actually gets over the line. I'm not asking you to stick your hand up and go, is it going to happen? Is it not going to happen? But do you think it's interesting that such large banks are looking to actually merge now and to take over other large banks because of the margins, and the balance sheets have gotten so much stronger than they were 5, 10, 15 years ago?
Yeah, that's exactly right, Peter. I mean, I would say like this increase in M&A activity. I mean, it's a little bit of an increase. This is perhaps the Commerzbank UniCredit thing is the most high profile. There's been a bit of M&A in banks in the UK, a bit of rumors of stuff in Spain. So I'd take it as a sign of confidence that, exactly as you say, balance sheets are in a good position. People feel comfortable about the regulatory environment not being crazy. So now it's the question of, okay, will politicians and other stakeholders allow us to merge across borders? Are we okay with allowing someone, a foreign-owned bank, to buy what you view as a national champion? I mean, as it happens in this case, UniCredit has had for a long time a position has owned a German bank called Hypo-Vereinsbank for a very long time. So in a sense, it is an in-market transaction, but that's not the way that the stakeholders see it. They see it as an Italian bank buying a German household name. I don't know. There has been a lot of backwards and forwards about who knew what. I think the chances of us getting an edge on whether stakeholders will block it or not is low. But where we're coming from on this, as UniCredit shareholders, is that we are broadly saying that we trust that the management is going to do the most value creating thing. So they've got a stake in Commerzbank. They've been quite clever about doing that through derivatives. They want to do the transaction, but it's mainly about delivering attractive financial returns. It's not just about planting poles somewhere and saying that, we need to be global or world domination. So we trust that they'll do the deal, but only if it's going to work financially. And if they don't, then maybe they do something in Italy, or maybe they just do more massive share buybacks. So that's how we're that's how we're kind of thinking about it.
Brilliant. I love that response. Thank you ever so much. Now, we're in the environment, or we've changed the environment over the last umpteen years now, where interest rates have been falling. Not sure where they're going to go over the next 3 to 5 years, but they have been falling somewhat. Is this a good environment or a better environment now? Everyone's saying it's a better environment for investments in banks. Is that likely to continue, do you think, Tom?
So I think the answer is, I think it is still a very good environment, because there is this, the direction of interest rates, it matters, but also what matters is the absolute level of interest rates. So like if you had asked a European banking CEO 3 years ago, look, I can promise you're going to go from 0% interest rates to 2 to 3, which is roughly where markets think that they might settle, they would have bitten your hand off for it. They just said, that's fantastic. It's so much better than the operating environment we had before. Your return on equity might be much better. So I think, yeah, it does make sense that the markets worry about, you've had such a big tailwind because interest rates shot up, now they're going down. That can't be a good environment for banks. Well, it's a bit more nuanced. It's about, you went up like this and now you're coming down, but you're settling at a much better place and the stocks are still very, very cheap. So that would be one thing. The other thing is that different banks have different types of sensitivity to interest rates. So in the UK, for example, one of the reasons why we like some of the UK banks is that they have structural hedges in place. And it sounds terribly complicated, but all that that's really done is it's delayed the benefit of interest rates going up. So they've still got those hedges that were in place at still very low levels of interest rates are basically rolling off. So they've still got this sort of earnings tailwind from these structural hedges to come over the next couple of years. So actually, even if rates in the UK were to drop a bit, they actually are far less earnings sensitive to that than you might think. So there are nuances which, when you do sort of the proper work, it sounds complicated, but it does make for a big difference between the different kind of companies that you might want to own. And we've definitely shifted our banks holdings, particularly in Europe, away from ones that are very interest rate sensitive and ones that are more sort of resilient for exactly this reason you said.
Thank you for that reply. I think that will allay some of Henry's concerns, because he's always been a bit pessimistic regarding banks. Henry, have you got a question related to that? Tom, please?
I mean, I've got this is going to sound like an incredibly basic question, but just for some of the members of our audience that aren't chartered accountants and financial analysts, could you explain a little bit about how these sort of interest rate hedges work? What are they? What do they do? Why do banks use them?
Yeah. Okay. Right. Now I mean, you're really getting into the weeds there, Henry. I think that the basic concept is just you're trying to reduce your exposure to changes in interest rates, and like an airline that hedges the oil price, you're trying to just, all you're really doing is smoothing the impact of a change in the thing that you're hedging on your business. Now, the UK stocks have got quite big hedges in place that have been in place for quite some time. So when interest rates shot up, the speed with which they got that benefit was really delayed. And actually, you're still going to get that benefit for the coming years. Whereas if you had had no hedges, the benefit, which is the case in some other banks across Europe, the benefit to your earnings came through really, really quickly. So it's really just a timing of the impact that it's that it's designed to deliver. And in the case of the UK, that's a really helpful protection to earnings in the coming years.
Got you. That's a good explanation. Thank you.
Brilliant explanation. Thank you very much, Tom. I'm like that. My brain's just going, ooh, just stretching to take all that information in. Thank you, sir. Right, we're going to talk about a situation now, Tom, which has been hot on all lips for some time, and even more so since Mr. Miliband and the government stepped in. We need to talk about climate change. We're talking about the recent hurricanes, of which there have been many across the US. Does it make it harder for insurers? You've got quite a large exposure to insurers in the portfolio. Does it make it harder for them to make money, profits, etc.? We've seen it regarding house and car insurance. We've all got to pay for it, and we're seeing the premiums go. We're going opening our little, renewals and going, what? With the increases.
Yeah, I mean, there was a time a few years ago where people thought that insurers would be sort of losers from climate change because in the end, they end up footing the bill when there are big natural catastrophes. Actually, like particularly reinsurance companies, which basically sell insurance to insurance companies, like assessing the risk of catastrophes and the impact of climate change and working out how to sort of price that and work out what the appropriate price is to charge you. That's like their bread and butter. So they are much, much more in tune with the impact of climate change than I think people realize. The other thing that's really helpful is that because the contracts, like the car insurance contract, it runs for 1 year. So you can, if you feel that you've underestimated the risk of climate change and natural catastrophes, you get a chance in a year's time to raise the premium. So these aren't super long-term contracts. So they're experts. The contract structures allow them to reprice it pretty quickly. And I would actually say that some of these sort of catastrophes, I mean, it's always pretty tragic and terrible to talk about what happened in Florida, and it really does impact real people's lives. But in terms of what it means for the industry, I would say these catastrophes have been one of the reasons why you're in a bull market particularly for reinsurance. And at the margin, it probably makes people more aware of the need to buy insurance protection because you're reading more about the risk of wildfires and hurricanes and the like. So I think actually it's an opportunity for the industry because contrary to what you might think, I mean, insurance companies want to pay claims because if they never paid claims, the product is redundant, right? So they want to pay claims. They just need to be appropriately rewarded for the risk that they take. And as things stand, they're being more than appropriately rewarded. So I think it's actually an opportunity for the industry.
Again, I'm just going to rewind a little bit there. Again, I work for Arthur Gallagher, the insurance broker, so I know the answer to this one, but I'm aware that people that don't work in the insurance industry won't know what you mean by a bull market in insurance. Could you just explain that a little bit for our audience?
Yeah, absolutely. So in reinsurance, the profitability that the reinsurers make is sort of, it's a normal supply demand dynamic. So supply is determined by the amount of capital that the reinsurers have to deploy. So if there's lots of capital chasing the same amount of demand, it lowers your pricing power and lowers your profitability. What's happened is the complete opposite. So you had a protracted period of losses that reduced the supply of capital. And that meant that last year, and particularly this year, they were able to raise their prices really significantly. What they also did was change the terms and conditions. So it's not just about the price you charge, it's also the policies sort of effectively, exactly, the policy wordings, the excesses have gone up a lot. So much more of the volatility, high frequency volatility stayed with the end customer. So combination of better prices, better terms and conditions has meant that, returns that reinsurers are making are really, really strong, but have only been strong for a year, and they had 5 or 6 years that were poor. So our view is that it kind of there's a story that or an anecdote that I think the management of Arch were using, that essentially the pricing environment has gone up in an escalator, up in a lift, and will go down in an escalator. So it's more prolonged favorable environment basically, and that's what we're backing.
Whether you are an experienced or new investor, you know how valuable it is to conduct portfolio enhancing analysis and to have easy access to data that will give you the edge. As a Twin Peaks Investing podcast listener, you can access an exceptional offer via SharePad from ShareScope, the UK's #1 investment data and analysis software for private investors and traders. This special Twin Peaks offer is available to new subscribers only, and you can subscribe using the promo code TWINPETES. The incredible and exclusive offer means that monthly subscribers will get their second month free, and annual subscribers will get their 13th month free. Sign up and subscribe to SharePad today using the Twin Petes promo code, and you can save up to £69. Visit sharescope.co.uk/SharePad for further details and subscribe to the investing and trading analysis and data you need.
Thank you for that reply, Tom. Now, you mentioned Arch already. Is there another stock that you have in your portfolio regarding reinsurers that you could tell us about, and also with regards to their strength in a very niche space, maybe?
Yeah, absolutely. So there's a UK stock that springs to mind that we like a lot called Beazley. I thought of it because you were asking.
That one. Sorry.
Right, there you go. Great minds and all. So the reason I mentioned that is because you said, being specialist in a niche. So Beazley operates through the Lloyd's of London market, has businesses in the US as well, has been doing that for a very long time. It's a really well-run company. But and they have exposure to the reinsurance dynamics that we were discussing through Lloyd's, and but the thing that's interesting about it is that about 20% of the business or so is cyber insurance, which is really a pretty hot insurance sort of category, as it were, because the risk to people from someone stealing your data or hacking your servers has, with the way that everything's interconnected in the cloud, is that risk has increased a lot. I mean, we saw that when there was this what was it called, CrowdStrike issue that basically grounded a number of airplanes, right?
Yeah.
So it's a really topical and growing thing. So essentially, most of the underlying insurance products that we deal in are, car insurance, home insurance, commercial property, standard things. This is like a new asset class type thing for insurance, and Beazley's been at the forefront of that, has got real expertise. So they are really plugged into, their chief exec was telling us, they're plugged into people at MI5 and CIA to make sure that they're fully aware of because some of these hackers, might be government-backed people. So they're fully aware of geopolitical things, not just where are the servers type thing. So it's a really fascinating product category that's growing. They have really good track record. Their exposure to the CrowdStrike was negligible because it wasn't the sort of not the kind of risk that they would end up taking. So the financial loss to them was actually very modest. But that's a really interesting one that's both reinsurance but has this cyber insurance angle too.
Yeah, they took a temporary sort of hit when people going, I wonder if they're exposed to it. And then when they explained that they weren't exposed to CrowdStrike, the shares moved up again. So yeah, they're
Peter, sorry to interrupt you. That was an example where, we talked in earlier about the UK election and saying that we don't tend to do short term. Well, when Beazley fell on the CrowdStrike, we bought more, because in that case, I think we we know the moving parts well enough.
Absolutely.
UK election, US election, harder.
That goes to the heart of our podcast, Henry and I. This podcast on Twin Peaks is about knowledge and research. Do the research, know what you own, yeah. And then when you see an opportunity, thinking this isn't right, this isn't accurate, it gives you that opportunity, opportunistic opportunity to go, bang, I'm going to have some more Beazley, I'm going to have some more of GSK or whatever the stock is, because having done your research, that actually, no, I'm not going to be swayed by the market's ignorance there. So no, thank you for that. It's almost on the cusp of the cyber side of it. We've got to talk about the AI side of things, Tom. We've got to. How does it impact financial, and what does it mean long term for financials? Will it make them more efficient? Will the back office and the customer service get better? what's your thinking regarding the AI and its influence on financials going forward?
Yeah, I think it's a fascinating topic, and so I mean, there's a couple of ways that you can approach it, right? I think everybody has found a way to find that AI is fantastic for whatever industry they look at, right? So everyone's trying to get on that bandwagon. There is, like, anyone who's dealt with a financial services business, particularly in the sort of traditional things like older established banks or insurance companies, knows that they're not. Now they spend a lot of money on technology, but they're not at the forefront, right? So I saw some really fascinating data from Accenture that looked at all industries globally, which had the highest proportion of their workforce that could be sort of benefit from AI-related automation. And banks and insurance companies are right at the very top of that list. Because, like, if you're doing like basic kind of processing or transferring data from A to B or things like that, that's an area where I think it's exactly to the point that you made in your question. It's an efficiency saving, and if that's a real thing, let's say, actually, Henry, you're saying working at a broker, if you're able to transfer the data into a submission slip automatically and make it less manual, like that could save time for you to maybe speak to another client or something like that. So the efficiency piece is a really interesting, and that's a real way to kind of create value in industries that tend to be sort of a bit slow at innovation. The other thing that you might say, and this I feel is you might be pushing the boat out a little bit, is that there's always this idea that banks and insurance companies have a lot of data about their clients, so perhaps you can use large language models or other forms of sort of machine learning to, I guess, better, more accurately price loans or insurance. I mean, it's fascinating. Companies like JP Morgan spends 15 billion a year on technology. I mean, there's serious investment going into this. I'd see that as a sort of option value. Let's not bank on that. I'm quite happy to take a world in which this industry uses AI to become more cost efficient. I think that would be a big win. That's sort of how we're thinking about it. That there aren't, so it's not something. It's something that we think about for all of our holdings, but it's not. It's something where we hope that the benefit comes through the efficiency rather than, right, we've got this one stock that is, the Nvidia financials type thing. That we haven't found that one yet. I mean, if you know it, then do let us know.
I don't know of it yet. I will tell you when I do find it, if I find it. But Henry works in the banking and the broking and the insurance side. The company he works for is all over that large space. So I was going to ask Henry a question in relation to what you've said there, as to how much innovation have you seen, or are you hearing going on at Arthur Gallagher's? Henry?
Well, massive, to be honest. I mean, I won't talk too much about Gallagher because we're a listed company, and you've got to be careful with what you say. But generally speaking, I think AI has been huge in office work. It's taken a lot of the manual labor out of things, and like you say, if you're doing repetitive process-driven tasks, it's fantastic. Saves a huge amount of time. But where it's particularly innovative is actually looking at large data models. So we've got a team of people that, I mean, they're our analytics team effectively. And we were talking earlier about catastrophe insurance. What happens if a hurricane hits? Well, we've got a team of people that can tell clients what will happen to their operations if a hurricane hits. So if you are, I don't know, an oil business or a power generation firm, you can model the hurricane going across. You can model the buildings that will be taken out. You can model the states that will lose power. You can model the catastrophe. There's a huge amount of information, which, sort of 15, 20 years ago would have been more or less pure guesswork. And that is where I'm seeing the real insight in AI and the real innovation. The other side of it is also around the cyber. So you were talking earlier again about Beazley going into cyber insurance. It's interesting that they are running at it, because an awful lot of insurers are doing completely the opposite and going, these risks are so huge, they're so unmanageable, we don't want to insure it at all, we daren't touch it, because the impact if something does happen is so vast, we just can't price it accurately. And I think it might be, I want to say Geico or one of Warren Buffett's insurers and they've just stopped writing cyber insurance altogether because of that risk. So being able to accurately analyze it and model what will happen is going to make a huge difference for insurers.
Yeah, absolutely. I mean, I think that's a very interesting point, because there is no such thing as an uninsurable risk. In the same, I mean, in the same way that there is a price for every asset, right? It's the same with, there's no uninsurable risk. There might be a price at which, I will only insure this at a certain price, and you might just not be willing to pay that. Okay, that's fair enough. But it's the importance of using data and analytics in decision making around the way that you price insurance risk or lending and so on is just really important. And so to the extent that AI can help the industry get better at that, I think it's I don't expect it to be a game changer. I think it might be one of these things that just the benefit of it ends up getting competed away over time. So my bet is that maybe we can make efficiency savings rather than that, but it's an integral part of what they're doing, definitely.
Thank you for that reply, Tom. Now, I'm conscious of how long we've had you on this pod, but we've got a few more questions we need to cover. And we mentioned earlier about the US elections. I just want you to expand on that. I'm not asking you to pick a side. I'm just wanting to ask you, with regards to how do you consider macro and the political, geopolitics regarding some of the areas that you're looking at. You mentioned Korea, for instance, earlier. You're talking about the stocks. You're talking about the political shenanigans going on, and the background to it. You're going, actually, there's a fantastic company there, but the politics there, we're still going to go there. We're going to take a smaller amount, or we're not going to go there at all. How do you make that decision? How does the team come to that?
Yeah, it's a fair question, because the thing that we really like to do is sort of analyze companies, find out which ones we think where the stocks are mispriced, and that's where we think that's where we have most of our edge. But the reality is that the companies don't just operate in isolation, right? So the political environment it is a factor. So generally speaking, particularly in a year like this year, where like half the world's population is going through elections of some kind, it wouldn't be sensible not to sort of think about it, particularly in terms of portfolio construction. So it's less about, I don't think it changes like the underlying economics of the businesses you invest in, but it might mean you want your portfolio sort of more or less exposed to the US, for example. So on the US election specifically, right? It's interesting because it feels to us that markets in the last sort of month or so, financial markets that is, are sort of have aligned themselves with what some of the betting odds have been saying, which is that it looks more likely now that Trump is going to win, and as a result of that, there have been various sort of consequences of that. So, riskier business. There's been a bit of a risk on even within financials. So financials have done quite well, but within it, sort of asset managers and consumer finance companies in the US have done particularly well. Yeah, and that's not been driven by earnings or something. That's just the stocks re-rating in anticipation of sort of, you've got this combination of, we're going to lower taxes, interest rates are coming down, it's a soft landing, it's like, it's game on. And Trump is, reducing regulation, so there might be more M&A. That feels to us something that the market has been very quick to price in. Actually, I mean, if you take a step back, the polls are like very close, even in the key swing states. I mean, I think Trump is ahead of Harris in most of the key swing states, but really by an amount that is so the momentum has been favorable, but the quantum is just within a normal sort of margin of error, I would say. And the betting market odds change. Who knows, how much emphasis to place on that. So I think, and even on like key topics, like the economy is probably the biggest topic of the election. And if you look at polling, like what do people think about, is Trump more reliable than Harris? It's like neck on neck in all cases. So I think we're sort of sitting back and observing. We have increased our allocation to US a little bit because the odds have changed, but this isn't a big this is a small tilt as opposed to anything. In terms of our actual exposure, so I'm trying not to dodge your question, but like I think that any the markets are already assuming that Trump's going to win, and we just I feel like it's far too close to call that. So our exposure in the US actually is mainly through insurance. Our biggest positions in the US are through insurance. So they don't really, neither candidates really have any direct implications for the insurance stocks per se. But for example, if Trump were to be elected and he cuts taxes, and that means greater fiscal deficits and maybe less regulation, so long-term yields have actually been rising, so the yield curve is a bit steeper. That's been quite good for banks. Banks have done quite well on the back of it. So there's an argument to say that Trump winning would be quite good for banks, particularly for sort of smaller regional ones. But it's something that we're sort of monitoring very, very closely. I mean, you have no idea how much time we've spent looking through various permutations about what will we do if this or that candidate wins, because it is just, it's the biggest market in the world. We've got to keep an eye on it, but it's very close. We're not massively positioned one way or the other because it feels so close.
No, that's a fair reply, Tom. And thank you ever so much for even going there. I appreciate that response. Thank you so much. We're going to move on slightly now and talk about inflation. It's been coming down in most places, including here. I'm not so sure where they got that 1.7 recently. I don't know what they put into the basket. And interest rates have been dropping as well. What are your thoughts regarding interest rates and inflation in the medium term, 1 to 3 years maybe?
Yeah. I mean, with the caveat that what we were saying earlier about trying to focus on the stocks. I mean, our base case assumption is inflation has come down, but settles at a higher level than it was before, and interest rates as a result settle at a high level and don't go back to zero. And I think actually, like, if that environment persists, I mean, the financial services sector is amongst the best placed in the whole market to benefit from slightly higher interest rates and inflation, assuming that there isn't a sort of recession or something coming down. And it does feel like the chances of a soft landing actually sort of keep going up. So actually that's a, soft landing with slightly better interest rate backdrop is really quite good for some of those financials, I'd say.
Okay. I'm gonna throw you a curveball here now, and I've touched on it earlier. I just want you to go into you mentioned it earlier, into the weeds. ESG factors seem to be weighing on financials. They're being asked all kinds of stuff, and now there's new fundamental ESG measurements being had for financials. Almost the same as they would be for an oil company or a mining company. How does the trust manage the ESG factors as such, Tom? And why should we as investors be concerned about this level of monitoring regarding ESG factors, do you think?
Yeah, it's interesting. The focus on the focus from our end investors on ESG has declined a little bit. But I think our view is that whether you call it ESG or something else, like we were talking earlier at the very beginning to Henry's question about managing risk, the best way to do that is to do proper fundamental analysis. So thinking about the governance of a business or social issues, if they're material to the investment case, I mean, that just feels to us like good common sense analysis has been done for a long time. I mean, we do have dedicated ESG engagements where if there are specific ESG issues, but our main focus is on trying to find, the best risk reward and see this as an integrated way of, or an integral way to making that kind of assessment. So we don't have any, there's no sort of, what we don't want to do, and I've seen in other places I've worked, is you get to a point where the ESG debate is more important than the fundamental assessment of whether this is a good investment or not. And we're quite and we're quite.
I felt the pain of that. Henry and I felt the pain of that, Tom. We know exactly what you're saying.
Yeah. So we're sort of, it's part of good, thorough, fundamental analysis to include factors that we're now labeling as ESG, and that's what we do and have done for a long time.
Brilliant. Do you want to add anything or another question to that, Henry? Because I know you're quite passionate about that, and as I was just saying earlier, we've felt the brunt of ESG valuations in the past.
Yeah, I mean, for me, it's a bit of a strange one. I mean, I work for an insurance broker. We've security out at the moment in the city because Just Stop Oil are protesting. Last year, we had bricks thrown at the building and all kinds of horribleness. And for me, the ESG thing with financials, I mean, I've always been fairly, some people would call it uncaring about it. Some people would say, realistic. But to me, financials, you are there to provide a facility to other businesses that are operating. And so I would be very surprised if looking at a business like Polar Capital, of course, you're going to have to take it into account because of the way the world is, but I wouldn't expect it to be a major factor when assessing financials. So I suppose for me, it's not really so much of a question, just, how big an issue is it for you when you're looking at these businesses?
The answer to that is a bit like how long's a piece of string. It depends on how material the consideration is. So yeah, I mean, yeah, it depends on how material we think it is to the prospects of the investment being a good investment. So there are certain things like I said, we have an ESG scoring that we use to assess companies to make sure, and that's a sort of proprietary thing that we've built, and that just is another sort of like financial metric to think about in the round with the other ones. Like if it looked really bad and really extreme, that's like saying, how much do you think about the balance sheet? The answer is, for some companies, for financials generally it's quite important, but for some companies it's just irrelevant. And it's the same with this. If there's something extreme going on that we think in ESG terms that might affect our ability to make money out of an investment, then we spend a lot of time on it. If it's immaterial, then we don't spend very much time. And that would apply to ESG as to any other bit of analysis that we do, I think.
Got you. That makes absolutely perfect sense. And I quite like that as an answer as well. So thank you.
Thank you, Tom. I've got a couple more questions, but we're going to have to call it now. What does the trust offer clients in this environment? We've covered interest rates, we've covered inflation, we've covered geopolitics, we've covered the change of government regarding the UK, potential change of government in the US. What are you offering clients right now? We've got certain levels of uncertainty waning. We're going to get some factual confirmation as to who's president in the US within weeks. Where now for PCFT?
Yeah. Okay. So what we're trying to do is so firstly, we think that the trust is very sort of differentiated, both in its sort of structure and its proposition. We're trying to give people broad exposure across financials globally, rather than just sort of owning UK banks, for example. And we're doing that in a vehicle that's managed by a specialist team that does nothing but that, of people that have gone through different cycles in financials. Like we discussed earlier, our view is that the underlying returns of the businesses are as good as they've been for a very long time, and investor positioning is sort of very light or underweight because everyone's focused on other bits of the market. So our thesis is you should think about diversifying away, doing it at a time when valuations in financials are still very attractive. So our hope is that people will agree with us that the trust is a really nice way to get this diversification in something where there's actually underappreciated improvement in return potential.
Brilliant, succinct reply, Tom. Thank you ever so much. Now, I've got a final question for you, and this is about where our global audience can find you. Listeners can find out more about the trust, events you might be attending, which they can actually see the individuals regarding the team and Global Financials Trust are present. Look them in the eye, ask them other questions which we've not had time to ask you today, please.
Yeah, absolutely. So the easiest place to look it up is just, we have a dedicated website for the Polar Global Financials Trust. That's got lots of details on the fund and how to invest, but also lots of thought pieces. I mean, I wrote an article recently on why you should be greedy for financials, sort of referencing Warren Buffett, sort of be greedy when others are fearful. We attend a number of like retail events, often often in London, but there's one coming up on the 19th of November where my colleague is going to be at the Mellow Private Investor Show in Derby, which I believe is the first sort of retail investor seminar outside of London for some time. So that's one that we're sort of excited about. But website's probably a good starting point, and then hopefully see you guys and some of your listeners at one of these retail shows.
Thank you ever so much. I want to confirm that I want to say it now because we've not told our audience yet, but we'll also be joining your colleagues of Polar Capital at the Mellow events, Mellow 10. It's the 10th anniversary. It's at Mellow Derby, the Derby Conference Centre in Derby. So Henry and I will be there, as well as Polar Cap and many other fund managers. So we'd love to see you all there. Check out the website for Polar Cap. Check out the specific information maybe on their website and also AIC's website regarding all of the holdings they've got, what their recent purchases are. And also, Tom, I think it's interesting that on a very consistent basis, you, Nick Brind, and the other members of the team are always out speaking with retail investors. We like to call them the real investors, not the city, the real investors. But you have done that on a quite consistent basis, unlike a lot of other funds which just, put material out and say, this is what we've done. You guys have always and ladies have always consistently gone out and spoken to and engaged with investors as well.
Yeah, it's an important part of our sort of prospective client base, and we're just, hopefully you get the sense of we love what we do, we love our sector, we think it's a really interesting time to look at it now. And the more people that are interested and the more opportunity we have to tell that story, the better from our point of view. So yeah, retail's an important part of that.
Thank you ever so much. Henry, what we'd like to say before we close this with Tom, it's been an absolute pleasure to speak with him.
A huge thank you to Tom for coming on. I mean, I feel like I've just been to the front seat of a fantastic seminar. So, hugely appreciate you coming on the show and spending your Wednesday evening with us. The only other thing I would like to add is a thank you to all the members of our audience that have donated to the Twin Peaks charity fundraise. We had a very exciting donation come in just a few days ago from a child of the 70s on Twitter, £100 plus £25 gift aid. We've also had Jeremy, £10 plus £2.50 gift aid, and we've had there was a gentleman I've just done an interview with as part of his PhD research, all into research into retail investors and what gets them into it, who's also donated £20 plus £5 gift aid. So thank you very much to all members of the audience that have donated. If you would like to donate after listening to this episode or any of our previous ones, the link is justgiving.com/page/Twin Peaks Challenge 24. And as a reminder, we are trying to raise £5,000, which will be donated towards Centrepoint, the UK's leading youth homelessness charity.
Brilliant. Thank you. Tom, is there anything you want to close with? It's been an absolute delight to have you on this podcast with us.
No, it's been a real pleasure, guys. Thanks very much for taking the time. I've really enjoyed our conversation.
Thank you ever so much, Tom. We will see you hopefully at Mellow. If not, we'll see you down in London because Henry lives and works around there and I pop down occasionally. Ladies and gents, from wherever you are in the world, take care. God bless you all. It's an absolute delight to have Tom Dorner, co-fund manager at the Polar Capital Global Financial Trust, with us today on this podcast, and obviously my co-host Henry Viola is here as well. It's been wonderful to speak to Tom, and it's been an absolute delight to actually get some insights into what's going on financially. I think even Henry might be making some purchases in the financial space going forward, given the insights Tom has shared. Until next time, we'll see you in 2 weeks' time, and also look forward to seeing you at Mellow Derby. Take care and God bless you all.
This Twin Peaks Investing podcast is brought to you in association with SharePad from ShareScope, the UK's #1 investment data and analysis software for private investors and traders. Visit sharescope.co.uk and discover the advantage.